Good afternoon to all of you. So we were discussing about monetary policy and banking as part of this initiative of Unacademy on their YouTube channel. So we have seen monetary policy. We have seen the instruments of monetary policy. So let us proceed and look at other aspects of monetary policy. The most important one, the analysis of monetary policy, which we have which we were supposed to do in the previous class. So let us look at this analysis of monetary policy. As we mentioned, if you look at India's monetary policy since independence, what can we say about India's monetary policy since independence? Historically speaking, if we look at India's monetary policy since independence, what we can say is that our monetary policy was nothing but an extension of our fiscal policy. It was nothing but an extension of our fiscal policy. What do we mean by that? From 1947 till 1991, when we implemented these economic reforms, Reserve Bank of India did not follow any independent monetary policy. The government of India had opted for expansionary fiscal policy. It had opted for expansionary fiscal policy, and it has also made sure that this monetary policy would be serving ultimately the interests of fiscal policy. We have opted for higher fiscal deficit, as we said, deficit financing. Before, till 1997, we had what is called budgetary deficit also as part of deficit financing. What is budgetary deficit? The government has looked for all the sources of revenue to finance its deficits. It was looking for tax revenues, non-tax revenues, loans, everything was over. Still, there is huge amount of deficit that has to be covered. The government had to spend that money. Where will the government get that money? The government would ask the Reserve Bank of India to print that currency. Reserve Bank of India would be asked to print that currency, and it would be asked to finance this deficit by printing that currency. Always, as we know, this kind of a printing of currency would automatically result in what is called inflation. That is the reason why all this period from 1950s to 1990s, the country had witnessed very high levels of inflation. On top of it, India had opted for, when it comes to its external sector, we have opted for fixed exchange rates. The exchange rates were fixed by the government of India. So Reserve Bank of India was not at all looking into the exchange rates also. Tomorrow we will discuss that entire external trade and balance of payment and everything else. So the monetary policy had two important objectives. First one was to ensure price stability in those days. Second one was to ensure price stability, and the second one was to ensure sufficient growth rate, so that Indian economy would grow at a very healthy rate of growth. But unfortunately, none of them were achieved because of a combination of a very weak and ineffective monetary and fiscal policies. The growth rates hovered around only 3.5%. What they relatively called it as a Hindu rate of growth, and the country also witnessed very high levels of inflation. It also witnessed very high levels of inflation. So this was what the situation at that point of time, and then monetary policy was more interested in financing the growth than in controlling inflation. After 1991, as part of reforms in monetary policy, the government had decided to give freedom to the Reserve Bank of India. In 1997, Reserve Bank of India took a momentous decision to stop this deficit financing, what we call it as budgetary deficit also. The government would no longer be provided finances by the Reserve Bank of India to finance its budgeted expenditure. It was decided that the government will finance its deficits only through borrowings, or through other means, but not depend on Reserve Bank of India. Reserve Bank of India would continue to finance the government for short-term expenses, for any kind of short-term discrepancies in revenues and expenditure. One of the important functions of Reserve Bank of India, as we know, is one of the important functions of Reserve Bank of India, as we know, is being a banker to the government. Being a banker to the government, the Reserve Bank of India is expected to cover up all kinds of deficiencies in terms of revenues and expenditures of the government by giving short-term financial assistance to the government of India. So this was the major change that had taken place. And another major change that had taken place as part of liberalization was another major policy objective was added to Reserve Bank of India. Another major policy objective was added to Reserve Bank of India, and that policy objective was what we call exchange rate stability. And that policy objective was exchange rate stability. And the government was expected to ensure stability in foreign exchange markets, because if the rupee either depreciates or appreciates, it will be negatively impacting either importers or exporters. We need that kind of exchange rate stability to realize the objectives of monetary policy also. This is what the government was supposed to do. And again, from 1997 onwards, the Reserve Bank of India started having more control over the monetary system, banking system. But still, the monetary policy was not as effective as it should have been, because some of these policies are what we call conflicting in nature. On the one hand, you have to support the government efforts to ensure rapid economic growth. On the other hand, you have to control the prices also. And this resulted in conflict in the policies here. This resulted in the conflict in the policies of the Reserve Bank of India. For example, if we look at it, if Reserve Bank of India has to control inflation, what it must do, as all of us know, if it has to control inflation, what it must do, it should focus on increasing the interest rates. As you know, the mechanism here, if it increases the interest rates, banks also will be forced to increase their interest rates. The cost of borrowing will go up. When the cost of borrowing goes up, the demand for investment funds would be coming down. And when the demand for investment funds is coming down, the money supply in the economy also would be coming down. When some money supply comes down, then incomes in the hands of people will be less. When incomes in the hands of people are less, then automatically the demand for goods and services will come down. When the demand for goods and services comes down, prices also would come down. This is the entire idea behind the monetary policy of Reserve Bank of India. This question has been asked by UPSC several times in our preliminary examination, including last year also. This has been asked by UPSC several times. How these interest rates are used as an instrument by Reserve Bank of India to control inflation. Has the Reserve Bank of India been successful here? That is what the analysis that we are talking about. The country had witnessed very high levels of inflation, especially during the mid-2000s. The period between 2009 to 2014 was the period when the country had witnessed very high rates of inflation, very high levels of inflation. And the then RBI Governor Subbarao, who was also India's foreign finance secretary, later he was made RBI Governor, and Subbarao, he kept on increasing the interest rate, this repo rate and reverse repo rates. They went to double digits also, 11%, 12%. But the inflation did not come down. The prices did not come down. For the simple reason that RBI's monetary policy can be effective only when the inflation is due to what we call demand pull factors. It was due to demand pull factors. But here in the country at that point of time, inflation was due to what we call cost push factors. it was the high cost of inputs that was resulting in very high levels of inflation at that point of time. The global crude prices per barrel had reached almost $150, because of which inflation was uncontrollable. RBI's monetary policy was not at all effective. On the other hand, what it was doing is that these high rates of interest were resulting in acting as negative incentives for growth rates. Because of the very high rates of interest, the industry was not taking loans, which was resulting in very low growth rates also. So monetary policy always had this kind of contradictions. If you want to control inflation, obviously the growth will be negatively impacted. On the other hand, if you want to have rapid economic growth, you have to compromise with inflation. And this is what exactly happened at that point of time. And then after that, thanks to decline in global crude oil prices, inflation was also under control. RBI could focus more on growth after 2014 onwards. Again, what happened after 2014 onwards? As I mentioned, from 2017 onwards, again the growth rate started coming down. Which was almost 8%, had come down to for 13 successive quarters. The growth rate was coming down, and it was almost by it had come down to less than 3.5% before the corona had struck. Then we can ask legitimately the question, what RBI is doing to ensure rapid economic growth. Please remember, this was also the period of what we call a very low levels of inflation. At this point of time, we had this MPC, Monetary Policy Committee, was formed to give directions to RBI regarding the realization of objectives like ensuring rapid growth rate and controlling inflation. It was decided that the inflation band can be around 4% with leverage given to RBI 2% this side and 2% that side. It can be between 2 to 6%. If inflation crosses 6%, then RBI will have to focus only on controlling inflation. Otherwise, the RBI can focus on what we call ensuring rapid economic growth. And during this period, what did RBI do? Since inflation was really within the control, it was never crossing the 6% band. So RBI could focus more on the growth, and RBI kept on reducing the repo rates and reverse repo rates to revive economic activity. When RBI was reducing the repo rates and reverse repo rates to revive economic activity, this is where we need little bit of analysis here regarding the functioning of economy. The question here is that when do investors invest in the economy? What are the situations wherein the investors will be investing in the economic system? So the industrialists will be investing in the economic system first and foremost only when they foresee demand for their goods and services. Only when they foresee demand for goods and services. As John Maynard Keynes would always say, it was expectations regarding the future. What happens at present is not what really decides the decisions of investors. What they are thinking about the future is what that really determines their decisions. And as we have mentioned, by 2017, the government of India had taken two important measures. One was demonetization, second one is implementation of GST. What both demonetization and implementation of GST have done is they have created very big shocks in the economy, not necessarily positive. And this resulted in suddenly investors losing faith in Indian economy. Economy which was growing at 8% per annum suddenly received this kind of two extreme shocks. So in order to nullify the impact of these shocks, the government of India had requested the Reserve Bank of India to soften the interest rates by reducing repo rates and reverse repo rates. The Reserve Bank of India followed the suggestions of the government of India and kept on reducing the repo rates and reverse repo rates. With reduction in repo rates and reverse repo rates, and with also quantitative, with also having more money in the banks, thanks to during demonetization, people have deposited huge amounts of money also in the banks. Banks were flush with funds, and the rate of interest was also very less. Ideal time for industrialists to have those what we call reviving the animalistic tendencies. But that was not what was the case in reality. RBI's monetary policy during this period again was not effective due to what we call this situation of a liquidity trap, as you can see here on your screen. It was not at all effective due to the situation of liquidity trap. So what is this liquidity trap? Let us try to understand this liquidity trap. If you already know it, it is fine. Otherwise, let me make these things very simple, because as I said, economics is always about making the common sense complicated. That is what we say economics. What do economists do? They take simple things, they take simple psychological concepts, complicate them, and call them as economic theories. So what happens here? Liquidity trap. As the question itself, the concept itself indicates, liquidity is trapped. Where it is trapped, with whom it is trapped, why it is trapped, and what are the consequences, is what let us try to look at. And this is what exactly happened with Indian economy also. So in any economy, we talk about two important players. Consumers and the producers. They are the ones who drive the economic system. Consumers and producers. They are the ones who will be driving the economic growth. Of course, government is also there along with the external sector, right? So, but two major players are consumers and producers. In India also, it is the consumption demand that derives the entire economic activity, right? That drives and derives the entire economic activity. So what happened here? What happened? If you look at consumers and if you look at producers, consumers, how do we define this interest rate? What is the definition of interest rate we give in economics? This interest rate is the price that we are paying to the consumers to postpone their present consumption. That is what we say. For example, I have say 1 lakh rupees with me. I have around 1 lakh rupees with me. Now, I can spend that money on consumption. That is, immediately I will go to the market and buy a refrigerator or a television or a two-wheeler. I can do the things. Or I can save that money for future. So if I have to save that money for future, I need some kind of incentive to postpone my savings to future. And what is that incentive? What we call it as interest rates. That incentive is interest rates. So if I am a consumer, when will I save more money as a consumer? When will I save more money? I will save more money as a consumer when I have this incentive of very higher interest rates. Then my savings will be also be higher. That is when I will be saving more money. On the other hand, if you are an investor, take the case of the other section of the economy, investors. On the other hand, take the other section of the economy, investors. So, you're a producer, you'll be taking loans. And for those loans, you have to pay rate of interest. That is what is called bonds. These bonds will yield a fixed rate of interest. So, when will you take loans? When the rate of interest is low. When the rate of interest is very low, you will take more loans. And when rate of interest is high, obviously your demand for investment will be low also. Now, with this, let us assume that economy is under recession. What is a recession? When for 2 successive quarters, when the economic growth rate is negative, that is what is called recession. It is negative compared to the previous year. That is what how simply we define recession. So what happened in India, was from 2017 onwards, slowly the growth rate was decelerating. And this is what exactly happened in 1930s in America. This recession slowly transformed itself into what we call the Great Depression of 1930s. And what happened here? In this situation, what happened was that the demand was very low, prices were low, incomes were low, then profits were almost zero, inventories were piling up, interest rates were also very low. So, as part of monetary policy, what do we do? As part of monetary policy, what do we do to revive economy when the economy is under recession? What do we do as part of monetary policy to revive economy when it is under recession? We, as part of RBI, as part of central bank, we try to reduce the interest rates. Why? Because the instrument in the hands of RBI is by reducing the interest rates, they will be incentivizing the producers. They will be incentivizing the producers to take more loans and to revive economic activity. Will the producers be taking loans? Will the producers be taking loans? Obviously, producers will not be taking loans. Why? Because there is no demand. Inventories are piling up. Inventory means unsold stock. These inventories are piling up. In your godowns, factory godowns, the cars, the two-wheelers, and all of them are piling up. So you will not take loans just because the rate of interest is low. On the other hand, take the case of a consumer. Take the case of a consumer. Take the case of consumer. Take his case. What about consumption demand? Consumption demand is also very low. Consumer has money. Let us assume that he has some amount of money. Will he save that money and deposit that money in the bank? Will he save that money and deposit the money in the bank? Obviously not. Why? Because interest rates are so low that it is not incentivizing. It will not be incentivizing the consumers. And what will he do? He will keep that money with himself, so that tomorrow, if for example you don't have any employment, you have lost your employment, you are jobless. You want to save that money, keep that money with you, so that tomorrow it can help you to satisfy your basic needs. And there is no incentive to put that money in the bank also. And why? Because banks are not giving you any good rate of interest. The interest rates are already very low. So whether it is a consumer or a producer, whether it is a bank or a government, there is huge amount of liquidity that is trapped in the system. Banks are willing to give loans, but nobody is willing to take loans. Consumers are having some amount of money, they are not willing to spend money. They want to postpone their expenditure. Why? Because again, as John Maynard Keynes all the time says, it is all about expectations regarding the future. So whether it is producers or consumers, there is no economic activity. That is the reason why under these circumstances, what happens is that the liquidity is trapped within the system. The money is trapped within the system. So this kind of reducing the interest rates will not have any kind of impact on reviving the economic activity. For example, you take the case of developed countries like Japan. You will be surprised to know that in Japan, from 1980s onwards, the real rate of interest is negative. How do we calculate this real rate of interest? In countries like Germany, it is also negative. How and why? Why? Because the real rate of interest is the monetary rate of interest minus inflation. For example, your interest rate is say 2%, inflation is say 3%. The real rate of interest is a minus 1%. So it disincentivizes the savers in the economy, because you will be getting negative returns. If I am putting 100 rupees in the bank, after 1 year with rate of interest that the bank is giving, it will be 95 rupees only. The real value of the money after 1 year is only 95 rupees. So there is no point in me, there is no point for me to put my money in the bank, because it will be giving negative rate of return also. So the liquidity is trapped. That is what exactly happened with the Indian economy in the last 3 years. RBI kept on reducing the repo rates and reverse repo rates. They have reduced it to very, very low levels. This was the demand of the industry also. It kept on reducing the repo rates and the reverse repo rates. And inflation was also fairly under control, thanks to drastic decline in global crude prices. In the month in 2017, I think around 2017, the global crude prices had drastically fallen to $29 per crude also. During the Corona crisis, you must be knowing it had come down to $0 also, right? So obviously, because of which the country had witnessed very low levels of inflation, so that Reserve Bank of India had absolutely no objection in looking at its most important objective, that was to control, that was to ensure sufficient amount of credit to the industrial sector. And during the Corona crisis also, RBI had come out with this policy of further reducing the repo rates, expecting that the banks would lend that money to the industrial sector. But this is not that will not be taking place during the times of recession. During these times of recession, as we have mentioned, liquidity trap is what we witness. Banks are flush with funds, and the prices are also very low. Interest rates are also very low. But the problem is that the economic activity is also coming down drastically. That is when the problem comes up. There is no economic activity. There is no economic activity. Because of which the industrial sector is not willing to take loans, further loans. If you happen to read Chidambaram's article yesterday in Indian Express, he had beautifully summarized the whole monetary policy dilemmas the country is facing. Monetary policy as well as fiscal policy dilemmas the country is facing. Our Prime Minister wants our industrial sector to be aggressive, to revive their animalistic spirits and invest heavily in the economy. And our industry minister really wonders why industry is acting in an anti-national manner by not investing sufficiently in the economy. Our revenue secretary wants to revive this infrastructure and industrialization. But what is the basic problem here? The basic problem here is that this monetary policy alone, independently, autonomously, cannot be effective. And what did the government of India do as part of this monetary policy, Reserve Bank of India, and also a combination of monetary and fiscal policies? The government of India had asked Reserve Bank of India to cut down drastically the repo rate and subsequently the reverse repo rates also, which RBI had done. It was not afraid of adopting this dynamic monetary policy. The Monetary Policy Committee was more than happy to cut down the repo rates and reverse repo rates because the inflation was completely under control. But the problem was that the banks were slush with funds. And what did the banks do? They had used the same reverse repo rate to benefit out of it. Banks were flush with excess funds. And what did they do? They had deposited those excess funds again with RBI. RBI had opted for before Corona, just after Corona, RBI had opted for quantitative, RBI had opted for expansionary fiscal monetary policy, and it had released more money to the banks so that they can give credit. But no one was taking loans. But no one was willing to invest in the economy. So what did the banks do? They have used this reverse repo rate in a route to again earn something out of the monies that they are with themselves. They were having huge amount of surpluses. Banks were having huge amount of surpluses. If they keep that money with themselves, obviously they would not be in a position to earn anything out of it. So what did they do? They had parked that finances with again RBI. During this 2 months of complete lockdown period and later, commercial banks in India have again deposited their excess funds with the RBI to the tune of, you'll be surprised to know, 8 lakh crores of rupees. 8 lakh crores of rupees were transferred from the banking system again to the RBI. defeating the very purpose of this expansionary monetary policy. RBI wanted the banks to give more loans, but the problem that the banking sector was facing at that point of time was the banks were having a huge amount of NPAs. And if they give more loans, there is every possibility that those loans also would turn into NPAs. So this expansionary monetary policy of RBI was not that much effective because the country was experiencing a situation of liquidity trap. People were also having some amount of money, but again they were also not spending. Why consumer demand is not reviving? Again, regarding the expectations regarding the future. During this last 1.5 years of Corona, what we have witnessed was around 9 crore people have lost their jobs. So whatever the savings they had, they were not willing to spend that savings. They were waiting for the economy to revive to get their jobs back, and then they would spend the money on consumption goods and everything else. And in the last 3 years, the government of India had opted for expansionary fiscal policies to revive the economic activity. The government had given a huge amount of bonuses to the government employees who are numbering around 5 million. There are around 5 million government employees which have come down to 1.8 million thanks to the number of jobs that had come down in the government. And the government had given government has paid all the government employees their dividends and everything else, and DAs and everything else was paid to them, expecting that they would spend that money on consumption expenditure. But what did the government employees do? They took the money, kept the money with themselves in the bank itself. Why? Because again, expectations regarding the future. Because the country is experiencing, please remember, everything is interlinked here. Monetary policy, fiscal policy, banking sector, industries, investment, employment, GDP. As part of your study of economy, you must interlink all of them. Why these policies are not successful is what we are discussing here. When the government transferred huge amount of money running into thousands of crores of rupees into the accounts of government employees during this period before Corona, we are talking about, hoping that the employees would in turn spend that money on buying consumer durables and other expenditure, basically refrigerators, color televisions, so on and so forth, laptops, computers, two-wheelers, four-wheelers, so that the economy can be revived. But what did the government employees do? They kept that money with themselves. Why? Again, Keynes come into picture, psychology. Economics is all about the psychological behavior of individuals. That is the reason why Keynes comes out with the psychological loss of consumption. Right? What did the government employees do here when they got the money from the government running into lakhs of rupees? They kept the money with themselves. Why? Because their children were graduating, and there are no jobs in the private sector. The country is witnessing jobless growth. So they did not know for how long they had to support their children. They had to support their children till they get till they get productive employment, and there were no jobs. Please remember, even those who are from IITs also, engineers were also not getting productive employment. It was either unemployment or underemployment. Only the top 4 IITs, they were able to get some kind of good employment, but again they were getting most employment in foreign countries. That was not that would not be benefiting India, because they will be getting money from they will going working in America, paying taxes to the American government. Whereas rest of the these engineers and doctors and MBAs, they were literally unemployed. So the parents simply did not know for how long they had to support their children. When the government had given them these DAs and everything else, they kept that money with themselves, and there was no revival of economic activity. Whatever the government had thought that would be done, that is reviving the demand, was never happened in reality. The demand was not revived. That is the reason why recently, the government of India, out of desperate measures, they said that we are giving you DAs, but it will be conditional. That means you have to buy something. You have to give us the bills. You buy something, and then you will be given. This was also made conditional transfers by the government of India out of desperation. That is what happens. So obviously, to the expectations regarding the future, the country is witnessing jobless growth. Economic growth is also coming down. Unemployment is going up, and the so-called middle class, there is a saturation point. For example, how many cars can you have? You will have only one car. And when Indians buy assets, they will be forever. That is, they'll keep the car with themselves. That is the reason why the government has said that these diesel cars will cannot be there for more than 10 years. Because you need to have revive the car manufacturing industry also. If you buy car and if you use the same car for 30 years, that means there will be no other asset also. That is the reason why the government has come out with this vehicular vehicle policy also recently, wherein it has said that the old cars have to be destroyed after 10 years, so that there will be further revival of demand for car manufacturing industry also. So all these policies are coming were introduced by the government with very little success also, and unfortunately we could not revive. We could not revive the economy. Coming back to the RBA and monetary policy dilemmas that it is facing at this point of time. What are the monetary policy dilemmas it is facing right now at this point of time? What are the basic weaknesses in the functioning of RBA also is what let us try to look at now. First and foremost, the RBI does not have a proper mechanism to accurately predict the growth rates. If you look at in the last 3 years or so, whatever the predictions of RBA regarding whether it is GDP growth rates or whether it is inflation, they were completely wrong. Normally, RBI's monetary policy is decided on the basis of its predictions regarding the growth rates and inflation. On the basis of that, RBI comes up with. And what we have seen here in the functioning of RBI in the last few years is that habitually RBI is overestimating the growth and underestimating the inflation. Out of a habit it has become overestimating the growth rates and underestimating the inflation, because of which RBI's policy instruments were completely ineffective. They were totally ineffective, because when you overestimate the growth, on the basis of that you will come out your policy instruments in the form of repo rate and reverse repo rate. When you are underestimating the inflation, again on the basis of that you will be coming out with that. The policy instruments would always become ineffective because of inability of RBI to predict these growth rates. Take for this year itself, what are the growth rates that were predicted by RBI and what are the growth rates that were predicted by IMF also. You can see huge amount of difference, at least a 3-point difference between RBI and IMF. Finally, RBI had to bite the dust and had to revise its growth rates. Why? Because RBI simply does not have any that kind of proper independent mechanism. Most of the time, these RBI's estimates are influenced by the finance ministry. That is what those who are in the power will always do. They always try to overestimate the good things and underestimate the bad things. But economy will not be well functioning according to the whims and fancies of those who are in positions of power. This is the first major problem that RBI is facing, overestimating the growth rates and underestimating the inflation. Second problem is, as I said, because of this, RBI was selecting wrong kind of instruments to achieve the objectives. It was selecting the wrong kind of instruments. Now, third problem that RBI is facing in terms of monetary policy in recent times is, the third problem is the government is dependent heavily on Reserve Bank of India to realize the objective of rapid economic growth. This is what the mistake the government of India is committing. What do we mean by that? After this lockdown was announced, the government of India had come out with this Atmanirbhar Bharat, and the Prime Minister announced that it will be almost 20% of GDP. The economic stimulus package would be almost 20% of GDP. Out of this 20% of GDP that the Prime Minister had grandly announced, 1.5% of GDP was in terms of fiscal stimulus packages. Rest of the was dependent on giving various kinds of loans. The government was trying to give loans to every sector, right from the big industries to street vendors also. All of them would be given loans. And recently also the government had come out with the policy to provide these subsidized credit to various sectors, especially what we call the small scale and MSMEs, micro, small and medium enterprises. The government had come out with the discounted rate of interest. The objective was to revive economy by giving loans to these small investors, medium scale industries, with the help of banking sector and RBI. And they would take those loans, they would invest in the economy, they would employ people. That would result in revival of economic activity. This is what our chief economic advisor Aravind Subramaniam also has repeatedly mentioned. He said that between expansionary fiscal policy, where the government is putting money in the hands of the people, like what United States of America has done, or what this Japan also has done, just transferring the cash to the people. He said that this kind of cash transfers would not work in a country like India, and he believed that more than these cash transfers, reviving the economic activity through credit would be a better option. And it was believed that RBI would be acting as a complete facilitator in the whole process of this banking system. RBI would be transferring more money to the commercial banks, and these commercial banks would in turn are expected to lend money to these MSMEs and other industrials, other big and small industrialists in the country. And banks were, as I said, were having excess funds. And as we have discussed, when the banks were having those excess funds, when there was no demand for these investment funds, what did they do? They transferred the same amount of money back to RBI. 8 lakh crores of rupees were again transferred back to RBI through reverse repo route. Ultimately, it did not result in any increase in economic activity. Why? Because this kind of credit-led growth could be successful during the times of boom. When the country is experiencing boom, then industry will be more than happy to take loans. When the rate of interest is also less, it will be icing on the cake for them. They would take more loans, they would employ more people, they would produce more goods and services, and they would also earn more profits. Right now, what is happening is that the economic system is such that there is no incentive for the producers, whether it is small or medium or big, to invest in the economic activity. Why? Because there is no visible increase in the demand at the ground level. For example, take the case of service sector. This service sector contributes maximum to our GDP. At this point of time, almost 57% of our GDP comes from service sector. Whenever you are talking about ancient rapid economic growth, it has to be done through service sector. During this corona crisis, you can see that agriculture was doing fairly well. In fact, it was doing far better than what the government had anticipated. Also, this year they are saying that our food grain production will be more than 300 tons. Also, so obviously million tons. So obviously it was more than what the government had anticipated. Also, but the problem is that the contribution of agriculture to overall GDP is very less. It is the service sector, and this service sector has been badly impacted by corona crisis. So nobody in the service sector is willing to take loans. Manufacturing sector, it has been stagnant for a long period of time. The government of India had come out with solutions like Make in India, Skill India, Startup India, all these programs, but they were not successful. They remained only on paper. So that is the reason why the government had combined all of them and called it as Atmanirbhar Bharat. But again, most of these policy initiatives are there in the documents, but not in reality. So obviously, this reviving economy through credit, which the government wanted to do, which our chief economic advisor believes is the right thing to do, will take a lot of time. It can be done. Definitely, there is no wrong in the argument that this kind of revival of economy can be more sustainable than putting money in the hands of the people. That is what our government also believes in rightly. But again, under the present situation, where your economy is undergoing severe recession, this kind of revival of the credit, growth rate through credit can have its own limitations, which we are witnessing right now in the form of liquidity trap. In the form of liquidity trap, the banks are flush with the liquidity. The banks are flush with liquidity. The liquidity is trapped in the banking system. Nobody is willing to take loans, in spite of the fact that the government had drastically reduced the interest rates, reverse repo rates, and also for these MSMEs also. But there is no revival. Why? Because as I mentioned, as I keep on mentioning, the government, as I keep on mentioning, the revival of economic activity is possible only when there is changes in the expectations regarding the people about the future. Still, people have so much of uncertainty regarding the future, and this is where RBI again was also, becoming a less efficient institution, because RBI wanted, the government of India in recent times wanted to achieve its growth related objectives not through fiscal policies but with the help of monetary policies. The government is depending less on fiscal policies and more on monetary policies to revive growth. How to revive growth through fiscal policies? How to revive growth through fiscal policies? Please remember, all these things can be asked in your preliminary examination. How can we revive economic growth? Through fiscal policies, by cutting down the tax rates, taxation. Obviously, when you cut down the tax rates, what happens? When you reduce the tax rates, automatically the disposable income in the hands of people will be more. When they have more income, there is more possibility of people. There is more possibility of people spending money. There is more possibility of people spending money. But what the government of India has done is that government of India has not opted for this kind of expansionary fiscal policy. On the other hand, the government of India, what it had done is that in spite of this severe crisis faced due to Corona, the government of India was hell bent on taxing people very highly, especially the petroleum products, because of which the real income in the hands of people had come down drastically. On top of it, on top of it, when the government increased these taxes, automatically the prices also went up. Inflation also had become very high. As you can see here, in recent times, inflation was very high, and especially this inflation, especially food inflation, was increasing at a very dangerous levels also, because this is what we say core inflation. This is what that really decides the consumer behavior at the worst level. When the inflation is very high, automatically what happens? The real income in the hands of the people will be less, and because of which the overall demand also will come down drastically. So the government of India, the policy blunder that the government of India is committing right now is, during the times of recession, as we study, monetary policy will be less effective, and the government should be opting for what we call expansionary fiscal policy. On the other hand, the government is depending more on monetary policy, and at the same time, the government is adopting what we call a contractionary fiscal policy with high tax rates. This is what the government has done. Secondly, as part of this expansionary fiscal policy, the government should be spending more. On the one hand, reduce the taxes and increase your spending. But the government of India is not willing to spend more. And what are the amount of money the government of India is spending? It is going to the people in terms of a kind, but not in terms of cash. What do we mean by that? For example, the government has said that it is giving 80 crore people the food grains, which is really good also. But this free food grains given by the government of India to 80 crore population do not revive economic activity. Why? Because they are getting food, but not any income or cash. There are no what we call cash transfers to the people. And what are the cash transfers the government of India had done during this period in the last 1.5 years of Corona? What are the cash transfers the government of India had done? Were very, very less to have any kind of impact on revival of economic activity. People living below poverty line, their families were given 500 rupees per month last year. 500 rupees per month is a peanuts, as all of us know. In a family of 5 or 6, if you are giving 500 rupees per month, they are given it for continuously for a period of say 6 months. So 6 months you are giving 7,500 rupees. 500 rupees per month means per person 100 rupees, which is peanuts. And similarly, as part of Pradhan Mantri Krishi Kalyan Yojana, the Kisan program, the government has transferred around 6,000 crores of rupees per year. 3 times in a year, 2,000 rupees again, which is very less amount of money. So the government, instead of adopting what we call expansionary fiscal policy to come out of this recession, had opted for contractionary fiscal policy, which in turn had led the economy into more recession also, rather than helping the economy to come out of recession. And what did the government do? On the other hand, the government depended more on monetary policy to realize the objectives of it depended more on monetary policy to realize the objectives of economic growth. As we studied in the last, as we discussed in the last 1 hour or so, this kind of expansionary monetary policy during the times of recession and depression can never be effective due to liquidity trap. That is where the government of India has failed, and that is where Reserve Bank of India also is a failure. Reserve Bank of India is also a failure. The interest rates are coming down, but banks are not able to give loans because there is no demand. On the other hand, Reserve Bank of India, under the directions from the central government, has transferred a huge amount of money to the commercial banks and other scheduled banks, so that they in turn can give loans to MSMEs and other sections of society. Unfortunately, they were not taking loans. You will not take loans just because you will not take loans just because it is coming at low rates of interest. So now looking at all these things, so what can be the ideal fiscal and monetary policy for the government of India at this point of time to revive the economic activity? Let us see what could be the solutions. These things can be again asked in your prelims examination. Which among the following measures can be used by the government of India to revive economic activity or to revive economic growth? Which of the following policies can be helpful to revive, to get the country out of recession? What can the government of India do right now, to revive its economy in a very speedy manner? First and foremost, the government must shed its conservative approach to fiscal policy and try to put more money in the hands of the people. How? As Keynes says, John Maynard Keynes, he said that if you want your economy to come out of the depression, ask the people to dig the land, ask them to take out the mud and then pour it again into the ditch there. Let them ask to do something and pay the money to them. Put money in the hands of the people. Put money in the hands of the people. Whatever it may be, put money in the hands of the people. That is what Keynes has said. That is what America has done. Transfer $1,200. And then after that, after Trump, again Joe Biden also has done the same thing. Every American got $1,200. And this is what the government of India has to do. It has to shed its conservative character in terms of its fiscal policy, and it has to be a little bit more dynamic. The government has to be a little bit more dynamic. Let the government give money. The 80 crore people which the Prime Minister is talking about all the time, forget about 8 crore people, take around 10 crore families who are living below poverty line. Give them at least 5,000 rupees, one-time payment, 5,000 rupees or 7,000 rupees, whatever it may be. It will be a huge amount of money, but definitely, it will help in reviving the sentiments as a psychological law of consumption, which John Maynard Keynes always talks about. If you put that money in the hands of the people, you are telling the people firstly that they don't have to worry about their future. There can be more certainty regarding their future. They can be looking into future with a lot of what we call positive expectations. That is what is needed for India at this point of time. With 9 crore people losing jobs, according to the government own sources, obviously what is required is not the credit. What is required is cash. What is required is cash. So, 10 crore families, each family given around 5,000 rupees. You can give it like for a period of 3 to 4 months continuously. And it will not be a huge amount of money compared to what our GDP is. This is the first thing that the government can do. Second thing the government can do is, government can reduce these petrol taxes on petroleum products. Both the central government, state governments, they are very, very high, incredibly high. It must be drastically reduced. Automatically, if you reduce this petroleum prices by at least 20-25 rupees, even then also they are very high. Right now, in most of the cities, it is around 110 rupees. In cities like Bombay, it is more than 110 rupees also. It should be brought down to around 70-80 rupees. It cannot be such high. It should be brought down to. There should be a Rubicon which the government should never cross as far as petroleum prices are concerned. It should never be allowed to go beyond 80 rupees. So that if the petroleum prices are brought down, automatically it will result in a reduction in, most importantly, consumer inflation, CPI, consumer goods, which again is very important from the point of view of the sentiments of the consumers. So when the prices are coming down, the real incomes will go up automatically. They will have more expectations, better expectations. Then the government can take immediate decisions related to what we call this privatization of public sector enterprises or the selling of government assets. That can be done. But again, the problem is that when you are in recession, there is no one to buy them also. When you are undergoing recession, there is no one to buy them also. You want to sell, these big public sector enterprises, we are running into thousands of crores of rupees. But who is there to buy them? If you are selling them to multinational companies, there is always scope for a lot of what is called systematic corruption. It is not as easy as it can be done. As someone is suggesting, let the government disinvestment from public sector enterprises. The government is willing to disinvest. The government is willing to raise good amount of money through disinvestment. But the problem is that who is there to buy in the markets? Stock exchanges, right? Our stock exchange is going right now, to very high levels. Maybe the government can use this situation in the stock exchange to, to sell these shares of the public sector enterprise and raise money. That money can be used to finance this transfer of cash to the people. That is what the next thing the government can do. This is what another thing that the government can do. What else the government can do as part of its fiscal policy? And the government must focus on cutting down these customs and excise duties. Since 2014 onwards, again, you will be surprised to know that these customs and exchange duties on exports and imports have reached almost the same levels of 1991, pre-1991. It is acting as a huge amount of disincentive for our exporters and importers. Obviously, Indian products are becoming less competitive in the international market. On top of it, this Atmanirbhar Bharat, with all the best of the intentions, can cause more harm because you don't. If you want everyone to come and invest in the country, you have to create the necessary conditions also. The problem is that, as I said, the government is not proactive in becoming part of this regional trading groupings, so that we can make use of these tax subsidies which are given to the member countries. The blunder committed by the government was RCEP. The government had, coming under the pressure from these industrialists, opted for protectionist measures by not joining RCEP. It has caused more harm to the government than doing anything good for the economy. On top of it, because of the tax revenues are coming down, what did the government do in the last 7 years? The government kept on increasing the customs and excise duties, which again acted as an antidote to the growth rate, revival of the growth. That is where again the government has to be a little bit more bold. It has to focus on reducing these customs and exchange duties, which have again reached prohibitive levels, and government should also focus more on signing these regional trading agreements, RTAs, which is very, very important to revive the economic activity. From the monetary policy front, the government has the Reserve Bank of India has very little freedom here on the monetary policy front. Why? Because Now you can see the consumer price index inflation has also crossed 6% levels. Once it is crossed 6% levels, the danger bells are ringing. RBI has no option but to increase the interest rates to control inflation. If interest rates are increased, automatically it can act as more disincentives for the industrial sector also. RBI has very little freedom now, has a very little leeway when it comes to monetary policies. That is the reason why what we say at this point of time is that the government should focus more on fiscal policies to revive economy than monetary policies. And RBI on its part must radically improve its functioning. How? RBI should focus on focus on getting its act together by coming out with correct estimates regarding the growth and inflation. Whether it is deliberately or consciously, what it was doing is it was inflating the growth rates and reducing the prices, the inflation rates, which is not doing any good to the economy, which is causing more harm to the economy. So this is what we say about fiscal and monetary policies and everything else. I thought that today also I will do banking, but it seems that the time is already over. So tomorrow we will go to the banking, and tomorrow we will continue with the rest of the things also. If you have any doubts, you can ask, or else we can meet tomorrow and continue with our analysis. Right? If you have any doubts, you can ask from what we have done today. Okay, then we can stop it here for today. Tomorrow we will continue with the banking sector, and tomorrow we will do other things also. Till then,